Welcome to ACCA Education. This is one of the subject in Applied Knowledge and the first level of ACCA. The old name of this subject is known as Accountant in Business and the new name is known as Business and Technology, which is also known as F1. The contents of this lesson are divided into 6 parts like Part A, Part B, Part C and so on. Part A is all about the business organization, its stakeholders, and the external environment. Part A has 4 sub-lessons which are 1. Business organizations and their stakeholders. 2. The business environment. 3. The macroeconomic environment. 4. Microeconomic factors. Today we are going to learn the first part of Part A, which is business organization and their stakeholders. Chapter 1. Business organizations and their stakeholders. Topic list. Purpose of business organizations. Types of business organization. Stakeholder goals and objectives. Organizations develop out of the need to coordinate work, Section 1, but this can be achieved in different ways. In this chapter we will also look at the different types of organization, Section 2. The objectives, policies, procedures, and management/leadership style of an organization will all be influenced in part by its stakeholders. Different stakeholder groups have different degrees of power and interest, and management must respond to each in a different way. Section 3. What all organizations have in common. An organization is a social arrangement which pursues collective goals, which controls its own performance and which has a boundary separating it from its environment. Here are some examples of organizations. A multinational car manufacturer, example Ford, a local authority and accountancy firm, example Ernst & Young, a trade union, example Unison, a charity, example Oxfam, an army. The common characteristics of organizations are as follows. A. Organizations are preoccupied with performance and meeting or improving their standards. B. Organizations contain formal, documented systems and procedures which enable them to control what they do. C. Different people do different things, or specialize in one activity. D. They pursue a variety of objectives and goals. E. Most organizations obtain inputs, example materials, and process them into outputs, example for others to buy. Why do organizations exist? Organizations can achieve results which individuals cannot achieve by themselves. A. Organizations overcome people's individual limitations, whether physical or intellectual. B. Organizations enable people to specialize in what they do best. C. Organizations save time, because people can work together or do 2 aspects of a different task at the same time. D. Organizations accumulate and share knowledge. E. Organizations enable synergy. By bringing together 2 individuals, their combined output will exceed their output if they continued working separately. In brief, organizations enable people to be more productive. How organizations differ. The common elements of organizations were described earlier, but organizations also differ in many ways. Here are some possible differences. A. Ownership. Some organizations are owned by private owners or shareholders. These are private sector organizations. Public sector organizations are owned by the government. B. Control. Some organizations are controlled by the owners themselves, but many are controlled by people working on their behalf. Some are indirectly controlled by government-sponsored regulators. C. Activity. What organizations actually do can vary enormously. They could be manufacturing organizations, for example, or they could be a healthcare service. D. Profit or non-profit orientation. Some businesses exist to make a profit. Others, for example the Army, are not profit-orientated. E. Legal status. Organizations may be limited companies or partnerships. F. Size. The business may be a small family business or a multinational corporation. G. Sources of finance. Businesses can raise finance by borrowing from banks or government funding or issuing shares. H. Technology. Businesses have varying degrees of technology use. For example, computer firms will have high use of technology but a corner shop will have very low use. There are two types of business organizations. 1. Profit-orientated. 2. Non-profit-orientated. An important difference in the list above is between profit-orientated, commercial, and not-for-profit-orientated, non-profit, organizations. The basic difference in outlook is expressed in the diagram below. Note the distinction between primary and secondary goals. A primary goal is the most important, the other goals support it. Private vs. public sector. Private sector. Organizations not owned or run by central or local government, or government agencies. Public sector. Organizations owned or run by central or local government or government agencies. Private sector. Commercial business organizations. A commercial business organization exists to make a profit. In other words, the costs of its activities should be less than the revenues it earns from providing goods or services. Profits are not incidental to its activities but the driving factor. Business organizations come in all different shapes and sizes, and there is a choice of legal structure. Legal status. Someone setting up a business can choose to go into business alone, take on one or more partners who also share the profits of the business, or set up a limited company. Limited companies. A limited company has a separate legal personality from its owners, shareholders. The shareholders cannot normally be sued for the debts of the business unless they have given some personal guarantee. Their risk is generally restricted to the amount that they have invested in the company when buying the shares. This is called limited liability. Whereas sole traderships and partnerships are normally small or medium-sized businesses, limited company status is used for businesses of any size. The ownership and control of a limited company are legally separate even though they may be vested in the same individual or individuals. A. Shareholders are the owners but have limited rights, as shareholders, over the day-to-day running of the company. They provide capital and receive a return. Shareholders could be large institutional investors, such as insurance companies and pension funds, private individuals, or employees. B. Directors are appointed by shareholders to run the company. In the UK, the board of directors controls management and staff, and is accountable to the shareholders, but it has responsibilities towards both groups' owners and employees alike. I. Executive directors participate in the daily operations of the organization. 2. Non-executive directors are invited to join in an advisory capacity, usually to bring their particular skills or experience to the discussions of the board to exercise some overall guidance. C. Operational management usually consists of career managers who are recruited to operate the business, and are accountable to the board. Types of limited company. In the UK, limited companies come in two types: private limited companies, example X Limited, and public limited companies, example X plc. They differ as follows. A. Number of shareholders. Most private companies are owned by only a small number of shareholders. Public companies generally are owned by a wider proportion of the investing public. B. Transferability of shares. Shares in public companies can be offered to the general public. In practice, this means that they can be traded on a stock exchange. Shares in private companies, on the other hand, are rarely transferable without the consent of the shareholders. C. Directors as shareholders. The directors of a private limited company are more likely to hold a substantial portion of the company's shares than the directors of a public company. D. Source of capital. I. A private company's share capital will normally be provided from three sources. 1. the founder or promoter. 2. Business associates of the founder or employer. 3. Venture capitalists. 2. A public company's share capital, in addition, can be raised from the public directly, or through institutional investors, using recognized markets. Many companies start in a small way, often as family businesses which operate as private companies, then grow to the point where they become public companies and can invite investors to subscribe for shares. The new capital thus made available enables the firm to expand its activities and achieve the advantages of large-scale operation. Advantages and disadvantages of limited companies. Advantages: more money is available for investment. Risk is reduced for investors thanks to limited liability. They have a separate legal personality. A company can own property, make contracts, etc. Ownership is legally separate from control. Investors need not get involved in operations. No restrictions on size apply. Some companies have millions of shareholders. They offer flexibility. Capital and enterprise can be brought together. Disadvantages: legal compliance costs. Because of limited liability, the financial statements of most limited companies have to be audited, and then published for shareholders. Shareholders have little practical power, other than to sell their shares to a new group of managers, although they can vote to sack the directors. The public sector. The public sector comprises all organizations owned and run by the government and local government. Here are some examples. The armed forces, government departments, most schools and universities. Public sector organizations have a variety of objectives. The UK Pensions Service administers part of the social security system relating to pensions, benefits and retirement information. The post office makes a profit from mail services, although it does have a social function too. Key characteristics of the public sector. A. Accountability, ultimately, to Parliament. B. Funding. The public sector can obtain funds in three main ways. I. Raising taxes. 2. Making charges, e.g. for prescriptions. 3. Borrowing. C. Demand for services. There is a relationship between the price charged for something and the demand. In the public sector, demand for many services is practically limitless. D. Limited resources. Despite the potentially huge demand for public services, constraints on government expenditure mean that resources are limited and that demand cannot always be met. Advantages. A. Fairness. The public sector can ensure that everyone has access to health services. B. Filling the gaps left by the private sector. This can be done by providing public goods, such as street lighting. C. Public interest. Governments once believed the public interest was best served if the state ran certain services. D. Economies of scale. Costs can be spread if everything is centralized. E. Cheaper finance. Taxes or borrowing backed by government guarantees might be cheaper than borrowing at commercial rates. F. Efficiency. The public sector is sometimes more efficient than the private sector. The UK's National Health Service, despite its well-publicised problems, has lower administration costs and serves more of the population than the private sector does in the US. Disadvantages. A. Accountability. Inefficiency may be ignored as taxpayers bear losses. B. Interference. Politicians may not be familiar with the operation of a business, and yet political pressures and indecision may influence adversely the decision-making process. Pressures to get elected may lead to the deferral of necessary but unpopular decisions. C. Cost. There can be conflict between economy of operation and adequacy of service. The public will demand as perfect a service as possible but will not wish to bear the cost involved. Non-governmental organizations. A non-governmental organization, NGO, is a legally constituted organization of people acting together independently from any form of government. Non-governmental organizations, NGOs, are bodies which are not directly linked with national government. The description NGO generally applies to groups whose primary aim is not a commercial one, but within this the term is applied to a diverse range of activities, aimed at promoting social, political, or environmental change. However, NGOs are not necessarily charities and, although they may have political aims, they are not political parties. NGOs need to engage in fundraising and mobilization of resources in order to ensure that they are operating effectively and efficiently, for example in terms of donations received, volunteer labor or materials. This process may require quite complex levels of organization. The following are some organizational features of NGOs. Staffing by volunteers as well as full-time paid employees, finance from grants or contracts, skills in advertising and media relations, some kind of national headquarters planning and budgeting expertise. It can be seen, therefore, that NGOs may need to possess an efficient level of organization structure, much in the same way as a traditional commercial undertaking. Cooperative societies and mutual associations. Cooperatives are businesses owned by their workers or customers, who share the profits. Here are some of the features they have in common. Open membership, democratic control, one member, one vote, distribution of the surplus in proportion to purchases, promotion of education. Although limited companies also have some measure of democratic control, this is on the basis of one share, one vote. So one shareholder could dominate a company if they hold a majority of shares. This would not happen in a cooperative. Mutual associations are similar to cooperatives in that they are owned by their members rather than outside investors. Some financial companies used to be mutual associations. However, building societies in the UK such as the Halifax converted from being mutual associations to being banks. The nationwide building society has held out against this, so far citing the lower interest rates it can offer to borrowers. Credit unions are examples of mutual associations. They are financial institutions owned and controlled by their members. Stakeholder goals and objectives. Managers are not completely free to set objectives, they have different groups of stakeholders to consider. The managers act as agents for the stakeholders, whose influence varies from organization to organization. The agency relationship in business therefore refers to the separation between an organization's owners, the shareholders, as the principal, and those managing the organization on their behalf, the company directors, as their agents. Those running the company should do so in a way that best serves the interests of shareholders, rather than pursuing their own interests. It is important that management interests are aligned with the organization's goals, so that they act in a way that benefits shareholders and other stakeholders. The concept of agency is particularly relevant for large organizations, where there is a large separation between company ownership and its management. Stakeholders are those individuals or groups that, potentially, have an interest in what the organization does. These stakeholders can be within the organization, connected to the organization, or external to the organization. There are three broad types of stakeholder in an organization, as follows. Internal stakeholders, employees, management, connected stakeholders, shareholders, customers, suppliers, financiers, external stakeholders, the community, government, pressure groups. Internal stakeholders. Employees and management. Because employees and management are so intimately connected with the company, their objectives are likely to have a strong influence on how it is run. They are interested in the following issues. A. The organization's continuation and growth. Management and employees have a special interest in the organization's continued existence. B. Individual interests and goals. Managers and employees have individual interests and goals which can be harnessed to the goals of the organization. Connected stakeholders. If management performance is measured and rewarded by reference to changes in shareholder value, then shareholders will be happy, because managers are likely to encourage long-term share price growth. 1. Connected shareholders, corporate strategy. Their interest to defend. Increase in shareholder wealth, measured by profitability, P/E ratios, market capitalization, dividends, and yield risk. Their response risk. Sell shares, example to predator, or boot out management. 2. Connected shareholder bankers, cash flows. Their interest to defend. Security of loan adherence to loan agreements. Their response risk. Denial of credit, higher interest charges, receivership. 3. Connected shareholder suppliers, purchase strategy. Their interest to defend. Profitable sales payment for goods, long-term relationship. Their response risk. Refusal of credit, court action, wind down relationships. 4. Connected shareholder customers, product market strategy. Their interest to defend. Goods as promised, future benefits. Their response risk. Buy elsewhere, sue. External stakeholders. External stakeholder groups: the government, local authorities, pressure groups, the community at large. Professional bodies are likely to have quite diverse objectives. External stakeholder government. Their interest of defend. Jobs, training, tax. Their response risk. Tax increases, regulation, legal action. External stakeholder interest or pressure groups. Their interest of defend. Pollution rights, other. Their response risk. Publicity, direct action, sabotage, pressure on government. External stakeholder professional bodies. Their interest of defend. Members' ethics. Their response risk. Imposition of ethical standards. Another approach. Stakeholders may also be analyzed by reference to whether they have a contractual relationship with the organization. Stakeholders who have such a relationship are called primary stakeholders, while those who do not are known as secondary stakeholders. The primary stakeholder category thus includes internal and connected stakeholders, while the secondary stakeholder category equates to external stakeholder status. Stakeholder conflict. Since their interests may be widely different, conflict between stakeholders can be quite common. Managers must take the potential for such conflict into account when setting policy and be prepared to deal with it if it arises in a form that affects the organization. A relationship in which conflict between stakeholders is vividly characterized is that between managers and shareholders. The relationship can run into trouble when the manager's decisions focus on maintaining the corporation as a vehicle for their managerial skills, while the shareholders wish to see radical changes so as to enhance their dividend stream and increase the value of their shares. The shareholders may feel that the business is a managerial corporation run for the benefit of managers and employees without regard for the objectives of the owners. The conflict in this case can be seriously detrimental to the company's stability. A. Shareholders may force resignations and divestments of businesses, while managers may seek to preserve their empire and provide growth at the same time by undertaking risky policies. B. In most cases, however, managers cannot but acknowledge that the shareholders have the major stake as owners of the company and its assets. Most companies therefore focus on making profits and increasing the market value of the company's shares, sometimes at the expense of the long-term benefit of the company. Hence, long-term strategic plans may be hijacked by the need to make a sizable profit in one particular year. Planning horizons are reduced and investment in long-term business prospects may be shelved. Clearly, each stakeholder group considers itself in some way a client of the organization, thus broadening the debate about organization effectiveness. Stakeholder mapping, power and interest. Mendello, 1991, suggests that stakeholders may be positioned on a matrix whose axes are power held and likelihood of showing an interest in the organization's activities. These factors will help define the type of relationship the organization should seek with its stakeholders. A. Key players are found in segment D. Strategy must be acceptable to them, at least. An example would be a major customer. These stakeholders may even participate in decision-making. B. Stakeholders in segment C must be treated with care. While often passive, they are capable of moving to segment D. They should therefore be kept satisfied. Large institutional shareholders might fall into segment C. C. Stakeholders in segment B do not have great ability to influence strategy, but their views can be important in influencing more powerful stakeholders, perhaps by lobbying. They should therefore be kept informed. Community representatives and charities might fall into segment B. D. Minimal effort is expended on segment A. A single stakeholder map is unlikely to be appropriate for all circumstances. In particular, stakeholders may move from quadrant to quadrant when different potential future strategies are considered. Stakeholder mapping is used to assess the significance of stakeholder groups. This in turn has implications for the organization. A. The framework of corporate governance should recognize stakeholders' levels of interest and power. B. It may be appropriate to seek to reposition certain stakeholders and discourage others from repositioning themselves, depending on their attitudes. C. Key blockers and facilitators of change must be identified. Each of these groups has three basic choices. Loyalty. They can do as they are told. Exit. For example, by selling their shares, or getting a new job. Voice. They can stay and try to change the system. Those who choose voice are those who can, to varying degrees, influence the organization. Influence implies a degree of power and willingness to exercise it. Existing structures and systems can channel stakeholder influence. A. They are the location of power, giving groups of people varying degrees of influence over strategic choices. B. They are conduits of information, which shape strategic decisions. C. They limit choices or give some options priority over others. These may be physical or ethical constraints over what is possible. D. They embody culture. E. They determine the successful implementation of strategy. F. The firm has different degrees of dependency on various stakeholder groups. A company with a cash flow crisis will be more beholden to its bankers than one with regular cash surpluses. So, different stakeholders will have their own views as to strategy. As some stakeholders have negative power, in other words power to impede or disrupt the decision, their likely response might be considered. The strategic value of stakeholders. The firm can make strategic gains from managing stakeholder relationships. Over the years, various theories and studies have revealed the following correlations. A correlation between employee and customer loyalty. Example: reduced staff turnover in service firms generally results in more repeat business. B. Continuity and stability in relationships with employees, customers, and suppliers is important in enabling organizations to respond to certain types of change, necessary for business as a sustained activity. Responsibilities towards customers are mainly those of providing a product or service of a quality that customers expect, and of dealing honestly and fairly with customers. Responsibilities towards suppliers are expressed mainly in terms of trading relationships. A. The organization's size could give it considerable power as a buyer. One ethical guideline might be that the organization should not use its power unscrupulously. B. suppliers might rely on getting prompt payment in accordance with the terms of trade negotiated with its customers. C. All information obtained from suppliers and potential suppliers should be kept confidential. Measuring stakeholder satisfaction. We have already considered ways in which stakeholders may be classified and given some instances of their probable interests. Measuring the success the organization achieves in satisfying stakeholder interests is likely to be difficult, since many of their expectations relate to qualitative rather than quantitative matters. It is, for example, difficult to measure good corporate citizenship. On the other hand, some of the more important stakeholder groups do have fairly specific interests, the satisfaction of which should be fairly amenable to measurement. Here are some examples of possible measures. Thank you. Like the video and subscribe this channel and click the bell icon for new updates. Support us for more ACCA education videos and other educational videos related to commerce field. Share for everyone's benefit.